Welcome to CFO 4.0, the future of finance. The CFO role is changing rapidly, moving from cost controller to strategic visionary. And with every change comes opportunity. We are here to help you take advantage of this transition, to win at work, drive your career forwards, and lead with confidence. Join Hannah Munro, Managing Director of ITAS, a financial transformation consultancy, as she interviews key experts to give you real-world advice and guidance on how to transform your processes, people, and data. Welcome to CFO 4.0, the future of finance.
Hello everybody and welcome to this episode of CFO 4.0. My name is Hannah Munro and with me today is Josh Schenker. Now Josh is the CFO of Aditude and we're here to talk about a few different things actually, Josh. Is that we've got a wide agenda for today's session. So great to have you on the show, Josh. Thank you for joining me. So tell us, Josh, tell us a little bit about your journey to CFO.
Sure. Thanks, Hannah. I started my career back in the day. I was in strategy consulting. I came out of, I was doing a master's program and decided that I was really interested in kind of how companies work and the processes in terms of how M&A is put together. So I started in strategy consulting, helping companies on the M&A side. That was corporate clients as well as private equity clients, work on due diligence projects and some other strategy projects as related to that. And it was sort of a great introduction into the world of finance and M&A. I got to really see a bunch of different industries, how they work, and kind of dive into those specifics. I then took that to go in-house to a large tech company where I was worked on corporate development. So actually running M&A deals for them, divestitures, M&A, strategic partnerships, all the things that kind of flow through corporate development. So I got to work on small acqui-hires up to $1 billion transactions. But as I kind of looked at my career, I wanted to learn more and more in terms of how to actually run a business. So I had the opportunity to move within a business unit and do business operations and strategy, and spent a few years working on projects with the general manager of that group. So ranging from, the nuts and bolts in terms of just putting together a financial plan for the business and seeing how we're, budgeting for the year and how we're, progressing against those goals, to large strategic, processes in terms of should we go invest in new areas of interest or not. So spent a couple of years doing that, and then got the entrepreneurial itch. So I had, up until that time, I'd basically spent my my career at large companies, so large consulting companies or that large tech firm, and at that point, I decided, I think I want to have more impact in the roles that I'm having. Not that it's, that you can't have impact at a big company, but it's just different when you're at a, 10, 20, 30 person company. There's not, there's not teams and teams of people supporting you. You have to, you have to sort of figure things out as you go. So I joined my first startup, call it 4 or 5 years ago. It was called Clean.io. It was in cybersecurity space around ad tech. And I spent close to 3 years there, took it through Series A into actual acquisition towards the end of 2022. And so we sold that business to a larger cybersecurity company. From there, I was COO at an e-commerce data startup. And then the Aditude opportunity where I am today kind of came out of my relationship, a couple of my relationships from my time at Clean.io, because actually Aditude was a client of ours. And I got to see Aditude in this interesting inflection point, where they went from Jared, who's the founder and CEO. He was doing consulting, and then he was shifting to more of a SaaS business. So I got to see them launch that product and really scale it up. And through our contact, through some mutual relationships that Jared had with some of the folks at Clean.io and the folks I worked with at Clean.io, we got introduced. And Jared was like, "Hey, why don't you come on board? We're looking to scale this up and continue sort of powering the growth, and looking for someone who can help on the CFO side as well as on the corporate development side." And that's kind of how I landed at Aditude.
Amazing. And I really love the fact that you've come from a slightly different background, because a lot of the CFOs historically that I've spoken to have all come from sort of a traditional accounting or CPA background. And what's really interesting is I'm seeing there's a bit of a shift, I think, happening in that CFO role. The commercial element of it's becoming almost more well recognized, as that, you can get people in from different backgrounds.
Yeah, I've had to. That's definitely been um, something I've learned over the last couple of years as I've gone into the startup world and been CFO at a couple CFO or COO at a couple different stops. I definitely didn't appreciate the level of sort of accounting and tax and sort of the nuts and bolts of actually running a business. But I like to think I'm a somewhat quick learner. so so I've sort of learned enough to help me sort of get by, and obviously had good mentors and good advisors sort of helping me along the way, sort of training me in terms of the key components on that side of the business, so that I can augment obviously the pieces on like the strategic and finance side that was that I worked in for my history to date.
And what's interesting, so obviously, you mentioned that you took one of your other or previous organizations through Series A, and I think Aditude as well has just recently been through a Series A funding round. So I'd love to learn. So let's just talk about, like, what does that process look like, particularly in Series A?
Sure. Yeah. So I think as you mentioned, so I helped Clean.io do a Series A back in 2020. That was definitely an interesting one, given that we went out to market maybe a month before the pandemic started, and I think that there was definitely a couple of sleepless nights as the pandemic was hitting, and basically capital dried up, overnight, where VCs weren't sure what was going to happen. I mean, I think the world wasn't sure what was going to happen, and so being able to go through that process in the middle, at the beginning of the pandemic, and able to raise money, I think was an interesting challenge, but definitely taught me a lot. Aditude also, we raised our Series A around a year ago, a little more than a year ago at this point. Very different sort of flavors of raising capital. Clean.io was sort of a more classic early stage startup that was raising money in order to grow the business to the next level, and sort of continue on that train of raising capital every couple of years, and trying to scale up like any early stage startup is, high growth early stage startup. Versus Aditude, as I had mentioned before, Jared had started this as a consulting business and had bootstrapped it until we raised capital last year, had been funded basically on operations. And so different profile type of company, different use case in terms of what we were trying to use the money for. So in the Clean.io world, we were funding operations, funding growth from an organic standpoint. We're trying to build growth from an organic standpoint, as opposed to on the Aditude side, this was more strategic capital or growth capital. Even though it was the first dollars in, it was more what I would think of as kind of growth capital, in the sense of using it for either some strategic marketing and branding, or acquisitions. And that's what we've sort of been focused on in 2024 in the two transactions that we've done to date. So, still obviously keeping our lean and mean approach to operating the business. But how do we pour some gasoline from an inorganic perspective to, match the organic growth that we're seeing?
And you mentioned that you learned a lot in that first round. Obviously, fundraising during such a challenging time of COVID, it must have been incredibly hard because there was so much uncertainty. And obviously, we work with a lot of SaaS companies, and it felt like for a lot of the ones that we were talking to, that the floor just dropped out of the bottom of all of their normal funding streams and approaches. So I can understand it must have been very challenging. So what did you learn? Did it change, I guess, your perspective on what makes a successful Series A funding application? Did you do anything different to raise during that time?
Well, I think, look, it comes down to your ultimately, it comes down to your performance that you're generating. Even when we raised in 2023, we were also in a somewhat sort of challenging environment coming out of some of the uncertainty that we had in 2022 and early 2023 in terms of the economic sort of market, and also, capital drying up. Not to mention that obviously we're in ad tech, which is a more challenging space. It's not AI or
the buzzwordy sections
buzzword
of
industries. We think, we believe in it, and we believe that we obviously can be extremely successful, which I think our investors do too. But in terms of going out to market, it's definitely adds a level of challenge. But I think in both of both of the fundraising processes, it starts with your numbers. It starts with the fact that if you have a strong product and a strong strong proof points in terms of, hey, we've been able to build a really good business, with either limited resources or no resources, that there's something here. So starting there, I think is going to be, is always going to help you, get a leg up and get you started. And then obviously being able to chart out the path of, how do we make this into a big business? So sort of selling the dream, selling the upside. I think in challenging markets, you need both, right? They want to see obviously proof that you've been able to do it. And then also that you have a big, you have this sort of the big picture outlined, and that, you're going after something that can be really big. So, I think that's the messaging that we went out to market with, and got a lot of no's as you would in any fundraising process, but found investors that believed in us and were willing to make a bet ultimately, that might have been against the grain, or at sort of take a challenge and believed in what we were trying to do here, in both scenarios.
And I guess part of that is making sure you find the right investors. So what was your process in both, I guess, who you're going to approach for funding, and how did you decide in the end which investors to go with? In terms of, did you have much choice over which ones you decided to go with in the end?
So approach in terms of who we reached out to. You start with a target list. This is like any sales process, right? It's a numbers game, right? So you have to go reach out to sort of a wide array of folks. You're trying to see, okay, who am I connected with? Who have I talked to in the past? As well as, who are mutual sort of connections that can kind of get us in front of the right people. So you start with, hey, here are the people that have either invested in our space in the past or might, sort of be investing in the space, and try to find those connections, and then start those initial conversations, as I said before. And so you kind of get you start to whittle down the list of people who are interested versus not. And then um, the folks who are really interested start to bubble to and I wouldn't say the bubble to the top, but they start to come out as like, okay, um, you know, there's mutual interest on both sides, right? So we're interested, obviously, for a number of different reasons. Either, they've invested in our space and had some good outcomes, um, uh, or we just know their sort of the reputation, and then they're obviously showing interest on their end, getting excited in terms of what we're building. And as you go through the process, it starts to come clear in terms of who the right fit is for you. And sometimes you have options and sometimes you don't, but sometimes it doesn't really matter, right? Sometimes it's you only have one option, but those are the right, that's the right person, or the right firm for what you're trying to build, moving forward.
And what would you like, knowing what you know now, with Aditude, what would you have done differently with that Series A round?
I'm not sure we would have done much differently. I think that at the time, we were more deciding, do we want capital or not? Not necessarily that, oh, we need to go raise capital, and who's the right people. It was more, do we want capital right now? Do we want to sort of raise money to go and do some more strategic things and try to scale up in an inorganic way, or um, or not? And then who's the right person to help us go and do that? And so, I don't know if there was something different than we would have done. I think it's just we came together as a leadership team, and decided that not only were our investors who we have now and have been extremely happy with, that's Volition Capital out of Boston, and so not only were they the right folks because they had sort of proven that they had some success in the ad tech space, and kind of knew what needed to be done to be successful there, but also that we wanted to go and tried to scale up a lot faster than we had been in terms of our organic growth, which was obviously great growth, itself.
And I guess what made you make the decision that now was the right time to raise capital? Because obviously you were profitable prior, by operations driving revenue and driving growth. What made you make that shift as an organization?
It was look, we were looking at the two options, right? We're saying, hey, do we just fund this? Do we continue obviously funding operations, from profit, and invest in things in a sort of a slower, more methodical manner, maybe do some smaller pieces of acquisition, based on just, with the cash on hand that we have, and try to be a bit more strategic how we go and do it. Or do we go and raise a larger amount of money, and that gives us the ability to go a lot faster, right? And so we decided that we wanted to take sort of bet on ourselves and believe that we could do things a bit faster. And we thought that the timing was right in terms of the market, and our ability to sort of execute against it, to go and do somewhat of a roll-up strategy in terms of our space, and be able to go and acquire other businesses. And if we had not taken the money, I think we would have continued to try to do that as well. It just would have taken us a lot longer. And so we just thought it was a great opportunity to go and raise the capital, to try to do it quicker, bigger, and better.
And did you evaluate different ways of approaching that funding? Like obviously there's lots of different ways to raise capital for M&A and acquisitions. Like, Was it something that did you always know you were going to go down this route, or did you evaluate different options?
No. As I said, so we looked at, I want to say three-ish primary things. One was fund from operations. We're going to let's continue to grow organically, take those profits and then invest it in potential acquisitions as we go.
Mm-hmm.
Stay lean, stay mean, and fund growth from operations. The other way was sort of a flavor of that was obviously fund from operations, but also look at potential debt to add on as we want to do the acquisition. So still stay within kind of what we can sort of bite off without choking, but maybe augment a little bit with some debt, slightly larger acquisitions than what we would have been able to do had we just tried to do it with operations. And then the third was obviously go out and raise capital and be able to do acquisitions at a larger scale quicker.
And you've obviously you've talked a lot about one of the primary drivers behind looking to raise the capital was obviously acquisitions. So tell me a little bit about how you approached your overarching acquisition strategy. Did you already have some acquisitions in mind, or was it that you wanted the capital and then went out to market to find them?
We had acquisitions. We definitely had some acquisitions in mind. Jared, the founder, obviously has been working in this industry for 10 plus years. And so knows a lot of the players and knows the folks that kind of were interesting to him in terms of whether it was just business combinations because they're competitors and it would make sense for us to combine with them, or new products that we had on the roadmap that he wanted, was thinking about it kind of in a build versus buy perspective. So there was definitely companies that he had in his mind. And then once we raised the capital, though, we definitely we worked with Volition a bunch in terms of, okay, here's kind of the initial list, and then even on with follow-on lists in terms of companies that are in our space that we should kick the can, sort of knock on the door and see if there's anything interesting here. And so we spent developing that list. So we started with an initial list that got us to our first acquisition, and then as well as the second acquisition, and we continue to add to that list in terms of companies in our space, and try to keep it sort of updated as we go, so that we can identify opportunities as they come across, and keep on sort of developing it as we go.
And when you were assessing those lists, how did you decide what to either prioritize or what was going to make a good acquisition? What are some of the things that you were looking for?
Yeah, the way that I look at it is in three. The target list is sort of in three different realms, right? So there's companies that are doing either the same thing as us or pretty much the same thing as us. So we're extending obviously more customer base there. Then there are companies that have additional products or features that are already on our roadmap and are in our space, but it allows us to sort of extend beyond it's built onto our platform, right? So extend our platform beyond what we do today. And then third are opportunities that take us maybe outside of our current industry, and that sort of play to our strong suits. So like, is there, I don't know, I'll give an example. We have analytics that we're doing in the ad tech space. Can those analytics get broadened to start to be interesting in other realms and other industries? And is there an acquisition that makes sense to sort of combine with what we do to allow us to go and move into a different industry and start selling there? So it's really those three sort of filters that we've been looking at. I think that primarily in the first two, but obviously we're trying to be, we still want to be opportunistic as it relates to the last one. As we start to grow and grow and grow, and maybe one day move beyond the ad tech space that we're in.
Amazing. And I guess in terms of once you've figured out that product wise they add value into the organization, I guess are there any things that you look out for that would make them, once you get to know them more, that would make them not a good fit? Are there any sort of warning signs that you're always really cautious around?
So beyond just filtering, obviously, for the three things I mentioned before there, we also are looking primarily at companies that are either break even or profitable. So we're not looking for companies where they're burning a bunch of cash and we're going to have to sort of either turn it around, or you're sort of betting on high growth for you to get out of sort of a negative profitability state. So I think that's one thing that definitely would probably sort of turn us away pretty quickly. Some other things I'm trying to think, like other stuff from a filter perspective that would potentially turn us away. Fit with the founders or the people that we think that we're going to be bringing on. That's definitely something else. So if there's as we go through the process, if we feel like it's not the right fit from a people and cultural perspective, that's also something that will make us sort of think twice in terms of doing a deal. And as we look at some of the more sort of product specific acquisitions, if there's questions that we have in terms of the product itself, and the validity of it, or the viability of the product, that will definitely make us sort of take a step back and say, okay, do we really want to do this acquisition, or should we pass?
Hey Google, what's the best accounting software for my business? Give it a couple of years, and I bet you she'll be able to answer you pretty accurately. But for now, it's still one of the few questions Google can't give you an answer for. But we can. Take our free quiz and find out which Sage product is the right fit for your business. Just head to itassolutions.co.uk.
And when you were going through your shortlist with the founders and the parts, were there any that you decided to do that? Was there a few that you actually decided, no, I don't, for whatever reason, these aren't a good fit for us?
We try to make the list, at least initially, we tried to keep the list in terms of actual opportunities that we thought were we thought were actually things that we would want to actually go and acquire. Yeah. So we try to filter those out before we get to the stage where we're actually talking to people. Mm-hmm. And some of that is just helpful, Volition does some screening for us. They're in market as an investor, and so they have different relationships with bankers and other folks that are sort of in the industry. So we can get hopefully a pulse on a company before we actually reach out to them, to get some, sort of basic understanding of, how they're operating, and should we be interested in them? And so we try to filter that stuff out originally. And in the case of, the past year, generally we've been talking to companies that were interested in acquiring, versus, getting to, further along and then deciding, hey, like this isn't the right fit. So sometimes, like, the biggest thing in terms of not acquiring a business has just been more timing or just interest, on their end in terms of actually selling. Sometimes it's just, okay, we're not really in market and we're not really ready to go and sell. Or, maybe they're thinking about doing something, like they'd rather, stay as an independent. And that's fine. Like we're obviously not forcing anyone to go and do this. We obviously, we're interested in their business because of, for a bunch of different reasons. But at the end of the day, this is it's a marriage of sorts. And so we want to make sure that, both sides are happy with the outcome. And so we try to, try to find the folks that are, ready to sort of dive in with us from the start.
And one of the things I'd love to talk to you more about is the due diligence process, because certainly when I've spoken to a lot of customers that are either pre or post, it's almost like in some instances the depth of the process is quite unexpected, like all of the things they're going to have to do. So yeah, you've done this for so many years. Tell us a little bit about like what you've learned about due diligence and I guess how you approach it.
And I have the benefit of having done M&A at a large company, having sold a business, so being on the opposite side of that table, and now having done it at a small company twice, and so I have a true appreciation for all sort of sides of it, right? And I try to take that mindset in terms of how to approach the deal and how I would want someone coming to me and sort of facilitating the deal. And so I try to make it as as painless as possible and try to be as transparent as possible and communicative in terms of the process. So that starts with due diligence, right? Just making sure that they understand that, look, we're gonna take a hard look at obviously all the different pieces of your business. It's not, this isn't anything, that we're trying to like, there's not a gotcha here. This is more just, we're trying to do a risk assessment and make sure that there's nothing that would preclude us from being able to, to buy the business. And so, we have to go through, the normal processes as legal due diligence and tax due diligence and financial due diligence and technology due diligence, and identify any issues that we need to clean up. And so I think it comes down to communication and transparency, where the more that you're being upfront and sort of honest and transparent with the other side, it makes it a lot easier because they're not wondering, oh, what's going on, or why are they asking this stuff, or are they trying to, are they hiding anything? It makes it a lot smoother in terms of a process if you're collaborating and pushing on things together, as opposed to sort of like in an acrimonious way of way of doing things.
Yeah, I guess you got to live with each other once you go through that process. So you can't, there's no point making it really painful and then expecting everything to be rosy.
I tell my lawyers that, like, we don't need to win, like during the process of doing like due diligence and the documentation process. It's not about like, that's not like, we don't need to win there. The winning is getting, acquiring the company and then growing the business. So if we waste our time trying to win during the deal, it slows us down in terms of what our ultimate goal is in terms of growing the business. And so I try to keep everyone sort of focused on the prize, and not get lost in some of the details that can bog down an acquisition. They're important, right? You don't want to ignore, either red flags as it relates to diligence, or, give up, all of, your protections as it relates to, the documentation side. But once again, making sure everyone sort of understands, like, let's keep things sort of middle of the road, market terms, and sort of, reasonable expectations on those pieces. And, sort of focus on, okay, how can we like get this done as quickly as possible, and actually get to building the business together.
And you mentioned there are different parts and sections to the due diligence process. So for those that have never been through that, I think you mentioned legal, obviously tax. What are the different elements of due diligence that a founder or CFO that's being acquired can expect?
So yeah, so it's all parts of the business. So legal, tax, financial, tech, HR. So really every piece of the business we're looking at to make sure there's no big liability, ultimately a big liability that we weren't aware of, or something that is, so bad that, wouldn't want to touch, it sort of precludes us from actually doing the deal. Luckily I haven't gotten to, got into that things, but I've seen some things where it's a higher risk, and we've had to sort of go back to the drawing board and work with the target to fix certain elements. So you take a deeper look at all aspects of the business, right? So you're going through contracts, customer contracts, make sure there's no clauses in there that would preclude us from moving over a contract into as part of an acquisition. You're making sure that the company was set up correctly, and there's no issues, there's no investors or former employees that are going to make claims against the business that would create headaches for you in the future. On the tax side, companies operate at different in different ways. Each company will operate in different ways. So have they been paying their taxes, correctly? Maybe they have, but they have a different approach, and you have to sort of take a view at, how, what do you think is the right way to do it, and how does that apply, sort of moving forward to the business that you're buying. On the HR side, are there any employment, issues that have come up in the past that you need to be aware of? On the tech side, obviously, you're looking at, how's their security, how's their, how's the foundation, foundational pieces of the business, not only the product, like how does it operate, but is it scalable? Are you buying something that's sort of duct taped together, or is it, have a strong sort of foundation that we can build off of? So really looking at all the different pieces, it's the CFO, being the CFO at a small company, you're probably focused on all the aspects outside of tech. And depending on if you have, a head of sales or not, you might actually also sort of be facilitating sort of the commercial due diligence as it relates to, sales and sales ops and those pieces. So it really depends on how big your company is, and what components you're going to be tasked with focusing on. But as an acquirer, we're going to look at everything, as I mentioned before, just to make sure there's no big risks or liability that are going to come out of the woodworks in the future. So yeah, that's kind of how we approach it.
And so, if you were going to give sort of top tips for a CFO going into being acquired, what would be the top tips for them? Like, how would you advise them to prepare? What sort of things should they be thinking about ahead of time? Because
I think this is the similar advice that I would give for someone who's going to raise as well, right? I think having your documents, your data room ready,
Mm,
or having a very clear picture on where the data lives, is going to make your life so much easier, because you're going to get, whether it's on a raising capital or on an M&A side, they're going to send you a data request list, and it's going to ask for a lot of this same, it shouldn't be surprising, right? There you can ask pretty much any lawyer or banker for a standard list, and they're going to be, similar to probably 98% of it, or 99% of it is going to be similar across all the different lists. So you can get prepared in terms of what a company is going to be looking for, or an investor is going to be looking for in advance. And it just makes things a lot easier if things are ready to go, as opposed to waiting potentially weeks to get certain pieces built out and provided to you. So if you're looking to do something quicker, obviously having those at least that initial set of documents. There's always going to be follow-on questions and follow-on analyses that need to be prepared, and that's fine. But getting that sort of initial set of documents ready, or having a clear sort of view on, okay, this is where all this data lives, and I can pull it together in a few hours if needed. That's kind of the first component that I think is the biggest thing that I think would be helpful for people in my shoes at other companies if they're going to raise capital or going through an acquisition. The other piece is more sort of deeper into the process when you're getting into the documentation phase, disclosure schedules specifically. So having that data room ready, or having the sort of an eye in terms of where the data is, will help out at the beginning. But as you go through the process and you get into the documentation phase and the disclosure phase, having a pretty good understanding of what potentially will need to go into a disclosure schedule is also something that takes time. And obviously the quicker you can do it, the quicker the process can go. And so having, either someone who's, sort of cataloging different pieces that go into something like that, or having, just having a good handle on your contracts and your other documents and anything else that might go into a disclosure schedule. That's just going to make things easier as you go through the process and trying to close the deal.
And are all disclosure schedules created equal? So
No,
does
unfortunately
every
not. No, not. But there are. I would say that you can prepare, or you can have an eye towards it, right? So
Yeah.
I've even told, one of the projects that I told our lawyers, so our lawyers to work on for us, and we're not looking to, we're not in an acquisition process or an investment process, but because I've been through it a bunch of times, I know that I want to have a clear picture in terms of where data lives and what are the things that might come up as it relates to a process. And so I've asked my lawyers, as like a sort of a longer term project, like, let's start cataloging all of our contracts and making sure that we have a sort of an understanding of any non-normal clauses that might need to be disclosed, or things that could come up as part of a due diligence, or things that might sort of get flagged in certain reps and warranties that you're making as part of that process. And so just keeping a regular process in terms of making sure that everything is being cataloged will help in a huge way. The other thing I think is more on like sort of like on the financial side, is really just having a strong sort of understanding of your numbers, which is it sounds simple and sounds sort of obvious for a CFO, but as you go through the diligence process and sort of all the the elements there, making sure that not only you have the data readily available, but that you can answer the questions in terms of why a certain month, if something happened in a certain month, and you can sort of answer the next level down, or even 2 levels down in terms of what's going on. It's just going to enable you to sort of move things quicker, as opposed to every time you get a question, you have to spend a week sort of digging through everything to figure out what's going on. So being organized in terms of obviously your financial data, and things as relates to your financial processes are going to just help in a huge way as you go through a capital raise or an acquisition.
And I am very aware that this has been such a great conversation. I've slightly run over time, so I hope you and our listeners don't mind, but this is great. So I'm going to ask on the flip side, right? So we talked very much about how you can prepare for being acquired. If you're looking to go out and acquire, what should you be thinking about when it comes to finding the right acquisitions and or preparing to go through that due diligence side on the other piece as well?
So, no, it's a great question. I think that I think in terms of preparing yourself, so obviously it starts with a strategy, right? It starts with making sure that you're finding the right targets that sort of meet the needs that you need. I think then on the other side, in the same way that you want to prepare your sort of financial processes and operations to be ready for to be acquired, you also need to make sure that you have those processes built out to acquire, right? Because you are bringing in a new business, whether you're doing an asset deal or an entity deal. It's a new business that has new products and new components and new ways that potentially people pay you, or that you have to bill people. And so really being strong at sort of like, okay, here's our current process, and then understanding how they do their pieces, is sort of almost the biggest battle, at the beginning, right? It's like it's not just understanding, okay, what does their P&L look like? It's like, okay, well, I'm taking over this business as of this date. Okay, well, how do we go and bill customers? How do we make sure that we're paying our vendors? How do we make sure that the balance sheet is appropriately, reflecting the business, and making sure that your processes allow for bringing in and scaling to incorporate another business inside of yours, is something that it can be challenging at times, but once you sort of have built the processes and sort of the foundation, it allows you to do multiple deals, one after another.
Amazing. Yeah, a production line of acquisitions is what we're going for here.
That's the hope.
Well, thank you so much, Josh, and some great content in there, and actually probably lots of things we didn't get time to explore, but it's been absolutely fantastic having you here, sharing your knowledge, Josh, and some great advice for those, either thinking about acquiring or going through or thinking about being acquired on both sides of the story. So thank you so much for sharing your story and obviously your experience working with Aditude. Before we finish, is there anything that you would like to, and if you want to learn more about yourself, maybe your background, or about Aditude, where's the best place to find you?
Yeah, well, you can obviously, in terms of Aditude, you can find us on our website, and that's aditude.com. And you can find us on LinkedIn and a couple other sort of social platforms. I'm also on LinkedIn as well, if you want to reach out to connect or sort of learn more in terms of my experiences to date. So yeah, that's kind of where you can find Aditude and myself.
Fantastic. And if you've enjoyed this podcast or you have some questions you think I should have asked Josh as part of this piece, then please do reach out. If we ask him very nicely, he might pop back on and answer them for us. So thank you so much, Josh, for joining me. And thank you to our listeners for tuning in. And I'll see you next time on the CFO 4.0 podcast.
So for those of you that don't know what we do here at ITA, so we are a financial transformation consultancy that specialises in Sage technologies, whether that is looking at a new solution, evaluating your current solution, or just helping you to get the most out of your current setup, we can help. But rather than me tell you all the reasons that you should consider working with us as a Sage partner or a transformation consultancy partner, I'm going to let our customers do the talking for us.
ITAS were there from the sort of get-go, helping us, talking through what the process was going to involve, setting expectations, making it clear that how much work we were going to have to put in to make sure that the project was a success at the end. And then talking us through all our different options, looking through our current processes, making us reevaluate what was important, which elements we wanted to move across to the new system, how we wanted to configure our new system, and also kind of making us sit back and really think about what is the success of this project? When we get to the other end, when we finish the implementation and we're in the system, what's success going to look like? And actually, putting that question back to us and really making us sit down and think about what is it that we are looking to gain from this whole process was really useful internally, making us really think about the key objectives and which areas to maybe prioritize over others. It was also really helpful sitting down and thinking about it rather than one big, huge project, actually splitting it down into different phases, sort of smaller bite-sized chunks, which made it seem a little bit more achievable within the time. And then thankfully, ITAS have been super flexible with us during this process because it happened to coincide our implementation with our first ever financial audit, which just took up huge amounts of our time that we didn't expect. So we did have to slightly push back some of our go live dates, and thankfully ITAS were accommodating and actually helped us navigate through that process. And like to say that thankfully we're out the other side of our first phase of go live, and loving the move to Intact.